One of the questions that investors ask very frequently is, will there be a major crash or stock market correction in 2019? The answer, we think, is quite probably, and the parallels go back to what happened in 1987 with the crash in October of that year. Now, the precursor for those movements were troubles in the bond markets. And one of the things that you actually saw unfolding through 1986 and then into 1987 was heightened volatility spreading out from the fixed income markets, moving to the forex markets, and ultimately ending up in the stock markets. And we think we're looking at a very similar pattern in 2018. Now, the critical thing to understand is that coming into this year, American assets, in particular American safe assets, the US dollar and the US Treasury bond, was something like 15 to 20% overvalued. So remember what we're stressing here. It's safe assets in America that are overvalued, not necessarily Wall Street itself. Wall Street is only overvalued relative to those other positions. If you look at the bond market and the currency market, the question clearly is, why did they get to that state? And the reason comes back to what was happening outside of the US at the time. America was beginning to recover, it was seen as a safe haven, and it attracted money from two other areas. One was fleeing flight capital from China, as President Xi's anti-corruption drive caused a lot of capital to leave China. That amount totaled about $1.5 trillion, so a sizable amount of cash. On top of that, Draghi, the head of the ECB's reckless, one would say, or certainly very generous QE program, also spilled over and caused capital to leave the Eurozone. That money essentially flooded into US dollar assets. It equally totaled about $1.5 trillion, so together what you had was $3 trillion of capital winging its way into the US. That capital is now leaving, and to draw the parallel with 1987, the key question is that going to be an orderly exit from US assets, or is it going to be a rapid and unsustainable one, dragging down Wall Street with it? We think the odds of that happening are probably quite great, A, because of the policy uncertainty in America, secondly because of the significant overvaluation of US safe assets. So if you look at term premia in the bond markets, they're still negative of about 126 basis points, when the normal average over the long term is a positive 125 basis point term premium. And thirdly, you've got evidence of economic acceleration occurring in the Eurozone and in Asia, which will be a magnet for those funds. So the risks are high.